18.7% in 2024. Okay. Hang Seng Tech Index was up more or less the same, 18.7% in 2024. But worth to note is the Hang Seng China Enterprise Index was up much more than the Hang Seng Index and the Hang Seng Tech Index. The CEI, the China Enterprise Index, was up 26.4% in 2024. We reckon that it's more because of the so-called China special valuation stocks, 中特股, state SOEs that pay high dividend and also is believed to be managing their market capitalization and to enjoy a higher valuation. So this reflected in the CEI, the rise in the CEI in 2024. Okay, as for the Shanghai Composite Index, it was up only 12.7% in 2024. And let's look at the index, the performance. Actually, the rally was happened between September and October last year, when the CSRC, the China Securities Regulatory Commission, announced certain measures, policies to pop up the stock market. Then we saw this very rapid rally, whereby the Hang Seng Index surged from around 17,500 to above 23,242, the highest level in October last year. But the rally was unsustainable. So you can see in November and December, whereby the early December, when the Politburo meeting was held, and also the China Economic Cooperation, China Economic Work Conference was held, there was a brief rally in the Hang Seng Index, rising to around 21,000. But after the two conferences ended, you can see the market resumed a downtrend, and today it was down more than 300 points because of negative news about Tencent. I will talk about that later. If you have questions about Tencent, I can also share my view about Tencent today. Okay. And Shanghai Composite Index, the rally in October last year brought the index to about 3,600, but it failed to hold about not even 3,500. After that, in November and December, you can see in this chart, there was resistance around 3,450, and now it was down to 3,200. Okay, almost the level in late September. Okay. Okay. Here are the winners and losers in 2024. Among the winners, Hang Seng constituent stocks, the stocks that rose the most was Xiaomi, 1810, ticker 1810. It was up 1.2 times last year, supported by recovery in the demand for smartphones, and as well as its venture into the EV market. In 2024, it rolled out its first EV car in March last year, and up to the end of 2024, it had delivered in total 135,000 vehicles. So surpassing its own target of 100,000 set earlier last year. And this year, according to its chairman, Lei Jun, the target, he has set a delivery target of 300,000 this year, compared to 135,000 vehicles last year. And then the second place was went to trip.com. It was up 94.5%, benefiting from a recovery in traveling after the end of the COVID pandemic. And also, lately, the Chinese government has relaxed the visa requirement for quite many countries, including Japan, Korea. So it helps in inbound as well as outbound uh, 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 visitation to China. Okay, inbound visitation to China. Meituan was also very stable last year, posting gains of 85.2% last year, supported by stable demand for its delivery service, food delivery service, and it has also launched a new delivery service called as Ping Hao Fan. Actually, the idea came from Ping Duo Duo. So someone coined it as Pinduoduo 2.0. Okay, so it's like grouping orders together to get a cheaper price. Okay, so it was told that it was reported that if you manage to group with other customers to order the same food delivery, the food cost which was supposed to be $50 now only cost twenty dollars, less than $30 because of the discount the restaurant give to the customers because it's a bigger order. Okay, so Meituan also benefits from the recovery in travel. Similar to Trip.com, as if one of its business is in hotel booking. Okay, the fourth place went to China Hongqiao. It was a aluminium manufacturer, which benefit from higher aluminium price last year. It was up 84%, but we are doubtful it can sustain the uptrend this year because of lower demand and also expected lower aluminum price in 2025. And then the fifth place went to Geely Auto. It did very well last year. Total car delivery reached 3.33 million in 2024. And then now its EV penetration rate was close to 50%. Last year, it has sold 1.48 million EV electric vehicles, accounting for 45% of its total car sales. And the company was very upbeat about the next 3 years. Its CEO has set a target of 5 million car deliveries by 2027, up from 3.33 million in 2024. Okay, and because of better economy of scale, it also sees an improvement in the profit margin, gross profit margin, better GPM because of selling more cars, better economy of scale. Okay, losers, Budweiser APAC 1876 last year dropped nearly 50%. The second worst performer was Heng Long Properties, a Hong Kong property investment company, because of lower occupancy rate for lower demand for offices. It was reported that now in Hong Kong, the vacancy rate for grade A offices rose to around 18%, 18%. So I think Hong Kong Land listed in Singapore was also impacted by this lower demand for office properties. Okay, Chow Tai Fook was the third losers, one of the top five losers last year. falling for more than 40% because of lower spending by mainland Chinese, both in China as well as in Hong Kong for jewelry. Okay, for Chow Tai Fook, actually more than 80%, close to 88% of its sales revenue came from mainland China. So a slower economy affected Chow Tai Fook more compared to other jewelry stocks such as Luk Fook, which was less affected because Luk Fook 60% of its revenue still come from Hong Kong. Um, Wuxi Biologics dropped 40.7% last year to 269 because of the worry that it may be under sanction, US sanction towards the CRO companies, okay, contracted research organizations. And Li Auto was down 36.1% in 2025 because of fierce competition in the EV industry, EV market in China. Entering 2025 on 1st of January, there was report that Li Auto and Xiaopeng were already started offering discount to their buyers. Okay, so in the amount of 10,000 yuan to 15,000 yen per vehicle. So 225, I think the competition will continue to be intense among EV manufacturers in China. Okay. Hang Seng Tech Index winners more or less the same candidates. You can see Xiaomi, Trip.com, and Meituan occupying the first three places among the winners last year. And then the fourth place went to SMIC 981. It was up 60.1% last year, benefiting from demand for more chips. Its production capacity in 12-inch chip has increased quite significantly last year. And now revenue sales from 12-inch chip account for 78% of its total revenue, whereas 8-inch chip only accounts for 21% of its total revenue. And it results in higher average selling price because 12-inch product are selling are more pricier than 8-inch product. Okay, and it also see better gross profit margin. In the third quarter of 2024, it recorded gross profit margin of 20%. Okay, compared to 13%, 13% in the second quarter. So because of increase in production capacity of its 12-inch chip production line, now its utilization rate was above 90%. So it also helped the gross profit margin to improve because of higher utilization rate. Okay, the fifth place went to Bilibili, up 51.7% because of more advertising revenue and also increase in GMV from its e-commerce. Okay, among the losers, you can see there are two EV manufacturers. Leo was down 52.7% last year, and Li Auto, which we mentioned just now, was down 36.1% last year. Both become victim of the price war in the EV market in China. And then East Buy, Dongfang Zhengsuan was down 35.3%, partly because the live streaming business now is also is becoming more competitive. 直播带货 it was one of the pioneers in introducing live streaming 直播带货. But now, as more there are more entrants into this so the competition becomes more intense, and each buy share price suffers. Okay. Zhong'an Online is an insurance company. Online insurance was down 34% last year. You may wish to know about the outlook for Chinese insurance companies, such as China Life and Ping An. Regretfully, our outlook for Chinese insurance companies was rather downbeat because of now the investment return. The main concern is lackluster investment return. First, on the first hand, we noticed that the bond yield in China, wow, has fell to a very low level. Say, for instance, the 5-year treasury bond yield in China, now the yield was less than 2%, only around 1.6%. While the yield came down, the bond price surged. So for insurance company, it's a tough time because by investing in bonds that yield less than 2%, so that they only manage to get a very poor investment return for their the investment portfolio. And on the other hand, the equities market is not doing well. As I showed earlier, the Shanghai Composite Index was actually range bound between 3,000 and 3,400. So the investment return from equities also did not fare so well. So for insurance company now, the biggest headwind is on the investment return side. Okay. Baidu dropped 28.8% last year. And actually, Baidu was quite a disappointment, despite that it has two concepts. Okay, Baidu had this AI concept. It's one of the first, the pioneers in developing AI application among Chinese internet companies, technology companies. And the other concept is autonomous driving. Yet it failed to lift the share price of Baidu, partly maybe because the monetization part. It has good concepts, but investors also demand want to see monetization, that company managed to derive revenue from those new business lines. Yet Baidu still takes time to prove that its new business strategy will bear fruit for the company. Okay, so these are the winners and losers for the Hang Seng Index and Tech Index. Now, let's move on to the three factors that could shape the Hong Kong stock market in 2025, namely Trump 2.0, Fed rate cut path, and China's economic stimulus 2024 to 2025. You may add one more, that is the U.S. Sino-U.S. relations, okay, or geopolitical tensions that will also affect the stock market this year. Okay, Trump will return to be the next U.S. president, and Republicans' Senate and Congress majority will give Donald Trump far more leverage to enact his legislative agenda, and crucially in confirming judicial and executive nominees, pass tax reform, fund border security, and overhaul the Affordable Care Act. Okay, so his government will certainly not become a lame duck, the so-called lame duck, because of the majority that the Republican Party managed to garner in both the Senate and the Congress. Okay, what investors expect from Trump? His America First foreign policy, prioritizing direct negotiation with trade partners and leveraging U.S. power for advantage, indicates a turn towards greater isolationism and less international collaboration. And his trademark incendiary rhetoric is likely to leave the world on edge. So the stock market, global stock market, will be bracing for more uncertainty because of his unpredictable comments or remarks he tend to make from time to time, and his likeness for social media to voice his views will also leave the world on edge. Okay, but for China, his greater isolationism and less international collaboration may work in favor to China because with his alliance, alienating some of his allies, such as Canada, Mexico, and Europe as well, because he's pondering about levying tariff on Europe. This may turn his allies towards China, less hostile against China. So this may work in favor to China. Okay, we sum up a few of his policy initiative. First of all, his tariffs. During his campaign, Trump stated that he would impose tariffs of 10% to 20% on all imported goods to the US, with tariffs on goods from China potentially reaching as high as 60%. And this could provoke retaliatory measures from targeted countries and severely impact China's manufacturing and exports. And this will also have an impact on the renminbi. China may be forced to depreciate the renminbi in order to remain competitive in terms of exports, and that will also affect the stock market, especially Chinese companies holding yuan-denominated assets. Okay. Crackdown on illegal immigration. Trump confirmed on social media that, as previously reported, on his first day in office, January 20th, he would implement large-scale deportation measures, including declaring a national emergency and potentially utilizing military resources. As for the impact, I will go into more details later. And then another of his policy advocate is massive tax cuts for US companies. So in addition to extending the tax cuts he passed in 2017, he proposed tax exemptions for tips, the elimination of taxes on social security benefits, and also a reduction in corporate taxes. Okay, this will bode well for the US stock market, as it will help boost company profitability by paying less tax. Okay. Another of his policy initiatives is climate rollback. During Trump's first term, he revoked hundreds of environmental protection measures, including pulling the US out of the Paris Climate Agreement. This time, he vowed to roll back Biden's clean energy policies, particularly to help the US auto industry. He also pledged to increase the production of fossil fuels in US using the slogan "Drill, baby, drill." Okay, so all companies may fare better under his rule in the next 4 years. Okay, ending the Ukraine war, Trump criticized the US for spending billions of dollars supporting Ukraine against Russia and promised to end the conflict through negotiation within 24 hours. All in all, Trump is a very money-minded person. So anything that costs the US money will make it think harder. Okay. Finally, his hawkish cabinet picks may have a negative impact on China. He's filling his incoming administration with figures known for their hawkish views on China. For instance, he nominated Marco Rubio as Secretary of State, former Director of National Intelligence John Ratcliffe to head the CIA, Fox News host and Army veteran Pete Hegseth as Secretary of Defense, and Florida Congressman Michael Waltz as National Security Advisor. All are hardliners or are very hawkish against China. Okay. Now let's go into more details about his tariff policy. Okay, generally the establishment of tariff will lead to three different scenarios. First, exporter lower prices to maintain competitiveness, resulting in reduced profitability for exporters. Okay, so this is for the exporter to stomach the tariff, to shoulder to bear the tariff. The second scenario is for the importer to absorb the tariff costs themselves, leading to decreased profits on the importer side. Okay, the first scenario is both exporters and importers are reluctant to absorb the tariff costs, so importer will ultimately raise retail prices, passing the tariff costs on to consumers. So generally, tariff costs are typically passed on to consumers rather than being borne by exporters or importers. And studies show that increased tariffs will ultimately hurt American consumers, hurt their buying power, as well as may push up inflation. Raising tariffs will also contribute to rising inflation in the US, which may slow down the Fed rate cut path. To avoid tariffs, Chinese companies are establishing factories overseas to meet international market demands. Actually, we see a rising trend that more Chinese companies are setting up factories in ASEAN countries such as Malaysia, Vietnam, Thailand, and Cambodia. Okay. Crackdown on illegal immigration. According to statistics, the illegal immigrant population in the US increased to 11 million in 2022, accounting for 23% of all foreign immigrants to the US. Illegal immigrants often provide immediate labor and are more willing to accept lower wages for physically demanding jobs. A large-scale crackdown on illegal immigration could lead to increased labor costs for lower skilled jobs. For example, the National Restaurant Association estimates that 54% of restaurant workers in the US are undocumented immigrants. Okay, so this will have a negative impact on inflation. Okay, we concerned that the combination of tariff policies and the crackdown on illegal immigration will lead to rising inflation in the US, causing markets to expect a slower pace of interest rate cuts. This could strengthen the dollar. Actually, lately the dollar index rose to about 109 before retreating to 108.5 lately. And this also increased US bond yields. The 10-year US bond yield now rose to about 4.6%. And this resulting in declines in dollar-denominated assets such as oil, gold, yen, and renminbi. This is the price chart of the four major financial assets after Trump was re-elected. You can see since November, since he was re-elected as U.S. president, U.S. dollar index surged from around 100 points to lately the highest was 109.5. Okay, so US dollar benefit from Trump's re-election, being re-elected. 10-year US bond yield also shot up to 4.6%, around 4.6%. And then crude oil dropped because of the stronger US dollar. And also weaker demand from China, expected weaker demand from China because of the relatively slow economic recovery in China. But lately, because of the cold weather in Europe and also the closure of the natural gas pipe by Ukraine, and also decline in U.S. oil inventory has helped support the oil prices. Now Brent oil was trading at 76 US dollars, and the WTI was trading at 74 US dollars. So for the next 2 months, we expect a correction after the sell-off in crude oil prices. We expect a rebound, a technical rebound in the next 1 2 months, supported by weather factor because Europe is now having a very cold winter, and also the mining activities in the US has also slowed down, as demonstrated by the number of oil rigs in operation. If you refer to the Baker Hughes statistics, weekly statistics of oil rigs in operation. So it has decreased, now dropped below 500 oil rigs being operated. Okay, gold was faring better compared to oil, partly because of expectation of lower interest rate, that the Fed has entered a rate cut cycle, and gold will benefit by a low interest rate regime. Okay, but on the other side, the upside will be limited by a stronger US dollar. Okay, and also the fund flow into cryptocurrencies may also undermine the performance of gold. Okay. Large-scale tax cuts, reducing corporate taxes, can create a more favorable investment and business environment for companies, supporting the development of domestic enterprises and driving economic growth. Goldman Sachs has pointed out that tax reform is an upward factor for the stock market, estimating that tax cut policies could increase the earnings per share of the S&P 500 index by 20% over the next 2 years. So now the consensus for the US market, it seems both analysts and investors are more upbeat about the US market in 2025. S&P target, I think, on average, is between 6,400 and 6,600. The more bullish call is 6,600. S&P index, 500 index this year, and the consensus is at least 6,400. Okay. Trump is expected to aggressively dismantle climate regulation. He also vowed to ease regulations on fossil fuel cars. Emerging renewable energy industries such as solar and electric vehicles may struggle to secure additional subsidies, impacting the development. So one of the sector, the solar industry in solar energy industry in China the more upstream value chain, the more upstream, such as production of polysilicon, production of solar panels, solar glass may suffer because of less demand from the US. Okay, and the exports of solar products from China mainly goes to the US and Europe. Now, Europe, with the weakening economy, is also expected to see lower demand for solar energy products from China. So, some of the solar glass companies, such as Xingyi Solar Glass, issue profit warning lately because of lower demand and lower prices for their products. Okay, the appointment of China hawks suggests tougher stance against China. It's believed that how to address the competition and confrontation posed by the US. They have these 3C policies. Okay, 3C stands for cooperation, competition, confrontation. But we reckon that cooperation may be less going forward between China and the US, but more competition and confrontation between the two countries. Okay, this will remain a significant concern for China for a long time. And meanwhile, investors should be cautious of the potential policy risks arising from the rivalry between the two countries, especially in sectors like technology, manufacturing, finance, energy, and resources, which are the main competition between the giants. Okay. Lately, one example is today, which happened is Tencent was being included in one of the lists that the US deems to be having, military ties, military influence, and then in response to this news, this US action, the Tencent share price tumble more than 6%, dropping below 400 Hong Kong dollars today. So going forward, investors should be cautious of the potential policy risk arising from the rivalry between China and the US. Okay, the other factor that will shape the Hong Kong stock market or even global stock market will be Fed's rate cut path this year. As mentioned earlier, the policy changes after Trump taking office may lead to a resurgence in inflation. And US core inflation posted a fourth consecutive 0.3% gain in November last year, showing that progress towards the Fed inflation goal has stalled. It may be increasingly more difficult or more challenging for the Fed to see the Fed funds, the inflation rate to be able to drop to its 2% inflation target, inflation goal. Now it remain quite stubbornly high. Okay, in the last meeting, our last FOMC meeting, the target range of Fed funds rate has been lowered by another 25 percentage points to between 4.25% to 4.5%, in line with market expectations. But Fed Chairman Powell expressed a cautious stance on further rate cuts in the coming years. And the Fed's latest dot plot, as shown on the right-hand side this year, you can see by 2025, end of 2025, the expected, the median forecast for the policy rate target range now was 3.9%. You can see here, moving up from 3.4% in September 2024. Now they expect only 2 rate cuts this year, of 50 percentage points, 50 basis points in total in 2025. Okay, and the median forecast for the end of 2026 is now 3.4%, revised from let me show, yeah, here, revised from a previous estimate of 2.9%. Now they are expecting the target, the policy rate target to be around 3.4%. That is 50 basis point higher than originally projected. So it also indicates a slowdown in the overall pace of rate cuts. Okay. Changes in market expectations particularly affect sectors that are sensitive to interest rate cycles, such as technology, utilities, and real estate stocks. But surprisingly, the tech sector are holding up well lately, but very concentrated in a few sectors, namely the semiconductor. Like yesterday, the Dow was down, but the Nasdaq was up more than 200 points because of strength in chip companies or semiconductor companies. One of the good news is one of the impetus is Microsoft plan to invest 80 billion US dollars into new data center, AI enabled data centers. Okay, and that may imply more demand for AI chips. These companies now get back to those companies that are sensitive to interest rate cycles. These companies require financing to develop their businesses, and a slowdown in interest rate cuts mean that future financing costs will remain high, causing companies to adopt a more conservative approach to new development plans, and that may decelerate their earnings growth. Okay, for high yield stocks, higher interest rates undermine the attractiveness of dividend use of these companies, leading to capital outflows from these sectors and impacting the stock price. One example is the utility stocks in Hong Kong. Except for CKI, Hong Kong Infrastructure, which benefit from the UK raising the water supply tariffs on water supply. Other utility stocks in Hong Kong, such as China Light, Hong Kong Electric Company, and China and Hong Kong Gas, Hong Kong and China Gas. In the last 1-2 months, their share performance underperformed the market because of expected of fewer interest rate cuts from the Fed this year. Okay. And property developers as well as property investment companies will also suffer because of their higher borrowing costs, as well as the attractiveness of their dividend yields become undermined because of comparatively higher US Treasury bond yields. Okay. The third factor that may shape the stock market is China's economic stimulus these 2 years, last year and this year. As China's economic recovery has faltered with sluggish GDP performance, now is less than 5%. Second, consumer confidence, growing clashes with the West, and a collapse in property prices that has caused some of China's largest companies to default, such as Hengda, Country Garden, and Agile. Okay, consumer confidence in China is approaching a historic low. The consumer confidence index hit 86 in July last year, just above the all-time low of 85.5 in November 2022 during the COVID pandemic. Now the COVID pandemic has ended, yet consumer confidence index remained very sluggish, very subdued. As short-term supportive measures rolled out last year have had a limited impact amid falling asset prices, moderate wage growth, higher unemployment rate, and also capital outflows. For many years, I think for close to 20 years, China saw the first outflow of negative growth in FDI, foreign direct investment, because of capital outflows. So over the past year, China's inflation data shows that the CPI has grown by less than 1% year over year, with some months even experiencing negative growth. Additionally, the inflation leading indicator, the producer price index, has recorded negative growth for 25 consecutive months, reflecting that China is not only facing deflationary risk, but the profitability of Chinese companies, especially the manufacturing company, is also under tremendous pressure because they cannot raise price. They cannot raise prices because of weak demand for their goods. Okay, so China is facing this deflation risk that will continue to impact China this year. Okay. Nevertheless, China has rolled out quite many policies to try to boost the economy. For instance, in April last year, it rolled out the third new national line rules. 国九条这个是新的国九条 new national line rules. The first national line rules was rolled out in 2004, and then the second national line rules was rolled out in 2014. So last year, every 10 years, they rolled out a new national line rules. 国九条. The objective of this national nine rules is to promote the high quality development of China's capital market. It's more targeting the capital market by strengthening regulations and guarding against risk. So one of the initiatives is to implement stricter entry rules for listings by putting forward higher listing standards, including indicators like the optimization and improvement of corporate revenue and net profit, higher quality requirements for listing counseling, improved compliance in the listing environment, including a severe crackdown on financial fraud and illegal reduction in shareholdings. So now they will hold the sponsors accountable. They may be subject to criminal punishment if any fraud is found. And they also aim to normalize the listing and trading supervision. Okay, so this benefits Hong Kong in a sense because now more and more companies ship to Hong Kong to get a listing in Hong Kong. So we see this recovery in the IPO market since July last year, since the second half of 2024, and we expect a continuation of mainland company coming to Hong Kong to get listed, and this will benefit the Hong Kong IPO market. Will it benefit Hong Kong EX? Yes and no, because it will what affects Hong Kong EX profits besides listing fees, listing fees income. More IPOs means more listing fee income. Yet on the other hand, the total turnover, you can see the daily turnover was quite unstable. In September, October last year, because of the 组合拳, which I'll also go into details later, the policy punch, 组合拳, that gave the market a boost in September, October last year. The market turnover uh, once went to about 600 billion Hong Kong dollars, but that was not sustainable. Now the market turnover dwindled to around 150 billion Hong Kong dollars. Sometimes even less. Like yesterday, the market turnover was only 100 around 100 million. Okay, 100 million. Yeah. Okay. Sorry. It was 100 billion yesterday. Okay. Market cap management. This is quite crucial because it helps the. This is also one of the reasons why at the beginning of this presentation, my chart shows that the China Enterprise Index outperformed the Hang Seng Index and the Hang Seng Tech Index, partly because of this market cap management. The CSRC issued the regulatory guidelines for listed companies number 10, market cap management, which require listed companies to take improvement of the quality of the company as a foundation, enhance operational efficiency and profitability, and make use of mergers and acquisitions, reorganizations, equity incentives, employee stock ownership plans, cash dividends, investor relations management, information disclosure, share repurchases, and other means to promote the value of the listed company's investments to reflect the quality of the listed company. So in the regulator's eye, a lot of Chinese companies, they are undervalued. So they're advocating more initiative to be taken by listed companies to improve their profitability and also pay more dividend to their shareholders. And as a result, they will see their share value bigger, higher market capitalization reflected in higher share price. That's the logic behind. Okay. The other initiative under the new national line articles is to strengthen the listing supervision, okay, to clear some of the bad companies from the Asia market, okay, by accelerating the formation of a normalized delisting pattern of the list as required and timely clearance, no postponement. Improve the compensation and relief mechanism for investors, while on the other hand, they also care about investors' interests. Improve the compensation and relief mechanisms for investors during the delisting process, requiring major shareholders and actual controllers responsible for significant illegal delistings to compensate investors for their losses according to the law. Okay. The other objective is to expand long-term investment strength, to establish a market ecosystem that fosters long-term investment, improve the basic system adapted to long-term investment, and establish a policy system to support long-term investment. In Chinese, it's known as long money, long-term investment. 长钱长投. What is classified as long money? Long money are basically referred to equity funds, public funds, or insurance fund. They invest for long term, not for short term profits, not going for short term trading. So they want to encourage more long money equity funds and insurance funds to invest in the stock market for a longer time horizon. Okay. And they also wish to encourage bank wealth management and trust funds to actively participate in the capital market. And the logic behind is they wish the stock market to rise so as to create the so-called wealth effect. People make money, make profits from the stock market, and then they are more willing to spend more. But looking at the performance of the stock market, it seems that this initiative has not worked out very well. Okay. Then in April, the CSRC, China Securities Regulatory Commission, announced 5 measures to benefit Hong Kong. Okay, this also benefit Hong Kong EX, namely to relax eligible products for stock ETFs under Stock Connect. Plans to moderately relax the average asset management scale requirements for eligible stock ETFs. In the past, the requirements on the market cap on the daily turnover was quite high. So only very few Hong Kong ETFs are eligible for Chinese investors for southbound trades. Okay, now they relax the requirement and also reduce the weight requirements for Hong Kong stocks in southbound Stock Connect ETFs and make equivalent adjustment for northbound Shanghai and Shenzhen Stock Connect ETFs, supporting the development of Hong Kong as an international asset management center. It is estimated now that southbound, that means capital inflow to Hong Kong from mainland China, now account for at least more than 30% of daily market turnover on the Hong Kong Stock Exchange. So in going forward, we expect this ratio to go up even further. We will not be surprised to see that southbound trades may account for close to 50% of the market daily turnover in Hong Kong. As more we see more capital inflow from China to Hong Kong. One of the reasons is a lot of the A+H companies, those companies that are duly listed in China as well as in Hong Kong, and the A share price are trading at a premium to the H share price. So for mainland investors, it seems more desirable for them to invest in to buy H shares instead of A shares for the same company, because H share is trading at a discount, sometimes 10% or even up to 20-30% cheaper than the A share counterpart. So this is also one of the reasons why we see more southbound trades coming from mainland China. Okay, inclusion of REITs in Stock Connect, it should benefit the REITs listed in Hong Kong, including linked REITs. But this is not one of, don't because of this, we get very upbeat about REITs, because there are other factors affecting the performance of the performance, namely their earnings, the profit, their yield. But inclusion of REITs in Stock Connect is one of the pros that we see for REITs listed in Hong Kong, aiming to generally follow the interconnection arrangements for stocks and ETFs in both regions. Because in the past, REITs are not eligible for investment for mainland investors through the Stock Connect. Now, eligible REITs from the mainland and Hong Kong will be included into the Stock Connect, further enriching the trading varieties available. And support for renminbi stock trading desk to be included in the Hong Kong Stock Connect. Many companies, listed companies in Hong Kong now, they have different currency counter trading desk or counter, such as they have dual counter, Hong Kong dollar and renminbi counter. So for mainland investors, because they are holding renminbi, so buying Hong Kong stocks via the Stock Connect in the past, they need to exchange to convert their renminbi into Hong Kong dollar, and they may they are subject to exchange cost. Okay, but now as renminbi stock trading desk would be included in the Hong Kong Stock Connect, that means mainland Chinese investors can invest directly into the Hong Kong market using the renminbi without the need to convert to change the renminbi into Hong Kong dollar. Okay, so this will also facilitate facilitate the southbound trade. Optimization of fund recognition arrangements. So there are 5 measures. The 4th measure is to optimize to promote moderate relaxation of the sales ratio limits for recognized funds sold in different locations, allowing Hong Kong recognized funds to delegate investment management functions to overseas asset management institutions within the same group as the manager, further optimizing fund recognition arrangements to better meet the diverse investment needs of investors in both regions. So this will mainly benefit the asset management industry in Hong Kong. The previous 3 measures will benefit the Hong Kong EX more, but this one will benefit fund managers operating in Hong Kong. The 5th measure is to support for leading domestic enterprises to list in Hong Kong. The CSRC will further enhance communication and coordination with relevant departments to support eligible leading domestic enterprises in raising funds through listings in Hong Kong. Lately, they are talking about reform. The Hong Kong EX is pondering over reforms of listing rules for companies that are already listed on the A-share market. They aim to shorten the application period. In the past, it takes easily 4 to 5 months, sometimes even more than half a year to get to apply for listing in Hong Kong. Compared to Singapore, I was told it will only take 2-3 months. So now they aim to shorten it to 2-3 months for companies that are already listed on the A-share market. So they come up with sort of a surface pledge that the inquiry will only there will be only 2 inquiries. In the past, it can be many rounds of inquiring questions and answers to and fro from the regulators and the listing candidates. Now they pledge to reduce it to 2 inquiries in total. Okay, so we expect more A+H listing in Hong Kong from this year onwards. Okay, I'll go into details later, more details later when I talk about the IPO market. Okay, subsidies for electric vehicle and home appliance replacement to stimulate domestic demand. This is the 两新政策以旧换新，就是 replacement of old existing EV and home appliance by new products 以旧换新. And then September, the very important policy combination punch 组合拳 the PBR the People's Bank of China cut interest rate and reduce the reserve requirement ratio RRR. So in 2024, the PBOC had cut the RRR twice, okay, releasing according to projection around 2 trillion yuan liquidity to the banking system. Okay, yet demand for loans remain sluggish despite more liquidity, because this actually hinges on investors as well as consumers' expectation of the market outlook. If they are not so confident, so even with a lot of liquidity, they may not be willing to borrow more. So if you look at for the first 11 months of 2024, new renminbi loan was amounted to 17 trillion yuan. 20 trillion is a big figure, but compared to 2023, it was down 20% compared to 2023 new renminbi yuan. That reflects that even with the RRR cut, that release more, that provides more liquidity to the market, yet lending, borrowing demand, loan demand remain sluggish because of the slow economic recovery. Okay, the other policy initiative is to allow securities funds and insurance companies to obtain liquidity from the central bank to support the market. The first phase, they target 500 billion yuan in the first phase. So this is a trial phase. They would do it incrementally or phase by phase. Okay, and they establish a special re-lending facility for stock buybacks for companies to buy back their own shares. And the first phase, they target 300 billion yuan. Okay, they also guide commercial banks to provide loans to listed companies and major shareholders for the purpose of repurchasing and increasing the holdings of listed company stocks. Pan Gongsheng, governor of the PBOC, further stated that if these two measures are implemented effectively, additional injections could be made in the future. So the first phase, it proved to be effective, proved to be successful, then you can expect more from the PBOC going forward. Yeah. Okay. So the logic behind is to support the stock market, hoping that there's more capital inflow into the stock market. So share prices rise, stock market rises, and then to create the so-called wealth effect, and then people may spend more and consume more, so as to support the economy. But if you look at the index, the Shanghai and the Shenzhen index, it seems this has so far limited results on consumption. The wealth effect is also not very obvious. Okay. October last year, they announced this 10 trillion yuan debt package. This is to address the local government debt problem. Okay, it is estimated that local government debt, the hidden debt off balance sheets, amounted to 14 trillion yuan. Okay, 14 trillion yuan, and they are also facing the pressure of repayment. So to avoid default by local government on their debts, this 10 trillion yuan debt package will increase the local government debt limit by 6 trillion yuan to replace existing hidden debts. That includes the loans, bonds, and shadow credits of local government financing vehicles, or LGFVs, local government financing vehicles, abbreviated. Okay, this new debt limit will be entirely designated as special debt limits, approved in one go and implemented over 3 years. So 2 trillion yuan every year. Okay, to help local government to repay their existing debt that they are maturing. Okay, and then for 5 consecutive years, 800 billion yuan will be allocated annually from newly issued local government special bonds, specifically for debt resolution. 化债 in Chinese is known as 化解的化, to resolve the debt problem, allowing for the replacement of a total of 4 trillion yuan in hidden debts. Okay, so in total, they aim to resolve 10 trillion yuan existing debts. Currently, the mainland government is introducing various fiscal and monetary policies to mitigate the downward pressure on China's economy, primarily including stimulating domestic demand, improving consumer expectations, resolving debts, and boosting the stock market. Okay. In December last year, there were two important meetings being held, namely the Central Politburo meeting and the Central Economic Work Conference, both held in December last year. Both meetings outlined several key priorities for 2025, reflecting the government's strong determination to implement more substantial policies. At the Central Policy Bureau meeting, the monetary policy stance have shifted from prudent. In the past, they put emphasis on prudent monetary policy, but this time round, they change it to moderately accommodative. So we expect more loosening monetary policy this year, including further interest rate cuts in the LPR interest rate, as well as more RRR cuts. Early this year, Han Gongsheng, the PBOC chairman, stated that the average reserve requirement ratio in China now, among commercial banks in China now, stood at 6.6%, which is very much higher than the other central banks of developed economies in the world. So there's still room for the PBOC to cut the reserve requirement ratio to allow commercial banks to have more money, more liquidity to lend to borrowers. Okay. The other initiative stated in the Central Politburo meeting was stabilize the real estate and stock markets while preventing and resolving risks in key areas and external shocks. Fiscal policy needs to be more proactive, enhancing exceptional counter-cyclical adjustments. One expectation is the raising of the deficit ratio in relation to the GDP. Over the last few years, China's deficit ratio in relation to its GDP was around 3%. So it's estimated that this year, the Chinese government will raise this deficit ratio to about 4%, which means the government will spend more to stimulate the economy. Okay, so another date to take note is March this year, whereby the CPC, China People's Congress meeting, and also the Liang Hui, the two important meetings to be held on the 4th and also on the 5th of March this year, whereby Beijing may announce more new policies to support the economy. So wait until early March this year. But before the two meetings in March, and also before the taking up of office by Trump, the stock market in the next half month to 1 month may be in a wait and see phase. Investors will become less willing to get into the market because of the uncertainties arising from Trump's returning to the White House. So the market is expected to continue to be under pressure or may at best trade sideways in the next 1 month. So we advise investors to wait at least after January, wait at least until February or until the two important meetings held in early March for further policy directions and also investment directions. Okay, so first quarter, investors need to be more patient and adopt a more cautious stance. This is our recommendation for the first quarter of 2025. Okay, Vigorously boost and expand consumption, improving investment efficiency, drive the development of new quality productive forces through scientific and technological innovation, and build a modernized industrial system. 新知生产力 this is to emphasize the development of these new quality productive forces. Okay. The Central Politburo meeting and the Central Economic Work Conference resolved vigorously boost consumption, improve investment efficiency, and comprehensively expand domestic demand. These are listed as the top priority. Actually, you can see a lot of overlapping between the two meetings, overlapping of similar policy initiatives, and sometimes market become inertia numb to the announcement from these important conferences because the wording are more or less the same. You see the repetition of the overlapping of similar phrases and statements. Okay. And then the other one is implement a more proactive fiscal policy, increase the fiscal deficit ratio, which I have explained just now, and reaffirm the implementation of a moderately accommodative monetary policy, more rate cuts, more RRR cuts, including timely reductions in reserve requirement ratios and interest rates. Continuously promote the stabilization and recovery of the real estate market, but it's not easy because the housing stock, the inventory, is estimated that it may take 4 or 5 years to digest the housing stock, the inventory, and drive the development of new quality productive forces, same wording, through technological innovation, manage involution style competition, and regulate the behavior of local governments and enterprises. Okay. This is more important. At least for the last 2 years, companies as SOEs that have this concept, valuation system with Chinese characteristics, 中特股, they outperform the market because of stronger financial strength and also higher dividend yield and also more support from the central government. So the State-Owned Assets Supervision and Administration Commission, SASAC, recently issued several opinions on improving and strengthening the market value management, 市值管理, manage market value of central enterprises holding listed companies, which includes 9 key points. And the main aspects are clarify the goals and direction of market value management, make good use of the toolbox, 工具箱, for market value management. The Chinese government always emphasize they have a big toolbox. They have many measure instruments to do certain things. So they have this toolbox for market value management. The document also proposes to incorporate market value management into the performance assessment of central enterprise leaders, guiding listed companies to increase the frequency of dividends, optimizing the timing of dividends, and raise the proportion of dividends. All in all is to entice investors to buy the stocks because of more attractive dividend yield, to increase dividend payout, to raise the dividend yield, to attract more investors. This is the logic behind. Besides China, the China Securities Depository and Clearing Corporation announced that to enhance the incentive for listed companies to distribute dividends and improve investor returns, starting January 1st this year, it will implement a 50% reduction in handling fees for cash dividends and distributions in the Shanghai and Shenzhen A-share markets. Additionally, handling fees for amounts exceeding 1.5 million yuan will be waived. So different bodies are offer their help for market value management. So to lower the cost for dividend distribution, so as to enhance the investment return of investors, to make it more attractive for investors to invest in those high dividend stocks. Okay. Okay, now we move on to the Hong Kong IPO market. In 2024, with the tightening of new company listing approval requirements on the mainland and the encouragement of leading domestic enterprises to list and raise funds in Hong Kong, the Hong Kong IPO market has significantly improved in 2024 compared to the previous year. Hong Kong recorded 69 IPOs, raising approximately 88 billion. Sorry, it should be 80. 80 should be, there's a typo error here. Hong Kong recorded 80 IPOs, raising approximately 88 billion Hong Kong dollars in 2024. This is a 1% drop from 2023's 70. At the end of 2024, it has increased to 80. So it's about less than 2% increase in terms of number of listings. But in terms of proceeds, money raised from the IPO, it recorded an 89% increase in proceeds from 46.3 billion in 2023. So 2024 total proceeds, IPO proceeds, increased to 88 billion. Okay, very auspicious figure. It helps Hong Kong to return to the fourth position in the global IPO market last year, trailing only behind the two US exchanges, New York Stock Exchange and Nasdaq, and India. And they were listing from first three special technology companies under the 18C chapter. So they created 18A chapter to allow biological companies with no revenue, no profits to get listed. Subsequently, they roll out this chapter 18C company to allow special technology companies with no revenue and no profit, to get listed. So last year, there were 3 such companies being listed. And also Hong Kong followed the US to allow SPAC company to get listed. So there's the SPAC listing after the introduction of these 2 new regimes in 2023. The 18C chapter was rolled out in 2023, and the rule about the SPAC regime was introduced in 2022. Okay, here I will also seize the opportunity to briefly talk about an ETF managed by PhillipCapital Management Hong Kong, which aims to track the performance of the newly listed companies in Hong Kong. This is the only only ETF that tracks the IPO market. Okay, the ETF is a passively managed ETF, aims to fully replicate the Solactive Hong Kong newly listed equities index, which tracks the performance of securities that have recently gone public or newly listed on the Hong Kong Stock Exchange. The index will undergo rebalancing every quarter, including securities that have gone public or have been newly listed in the past 756 trading days, which implies 3 years. Companies listed in the past 3 years will be included into the index, become constituent stocks of the index. Ultimately, it will not select all, like last year, there were 88 companies listed. The index will not include all the newly listed companies. It will select the 50 largest securities by free float market capitalization. And additionally, the index will also include newly listed securities that meet liquidity and market capitalization standards after a monthly review. This is the so-called fast track, like boarding a plane. If you are VI, you are taking the business class, or you are the gold member of airline company, you can have access to the fast track. Okay, so the index is rebalanced every quarter, but every month, if there's a newly listed company, if there are new listings, every month it will include those newly listed companies that are eligible, that meet liquidity and market capitalized standards. So these are the top 10 holdings of the index of the ETF currently, which include Neo, Ke, Holdings, Media, Meidi Group, Sense Time Group, J&T Global, Express, Horizon Robotics, Miniso, Giant Baojin Holdings, Zhejiang Leap Motor Technology, and XXF Group Holdings. Okay, it's very diversified. You can see there's no more than 50% concentration in a single industry or single sector. Come from we have companies from the auto truck manufacturer, manufacturing industry, real estate services, appliance, tools and houseware manufacturing, software companies, IT services and consulting company, retail place, and personal products as well. Okay, and also logistics companies. Okay, our Hang Seng Index first quarter target. Near support is 19,000. Now it's quite close. We may test this short-term support very soon, because today the Hang Seng Index fell to around 19,300. Okay, if the 19,000 fails to hold, the next support will be around 18,500, and the key support is 18,000, which is where the 250-day moving average lies. So today, from a technical analysis point of view, he has dropped below, has breached the support of the 100-day moving average. This is the 100-day moving average, around which lies at around 19,500. It may be testing the 250-day moving average if both support levels, 19,000 and 18,500, let go. Okay, near resistance is expected to be around 20,200.
Hi, everyone. Let's wait a bit for our speaker to get back to the call. Thank you. Welcome back, Liz.
Yeah, can you hear me?
Yes, we can hear you perfectly.
Yeah, I'm back. Sorry for the interruption because I wrongly hit the button on my keyboard. Yeah, you give me back. Let's continue from where I was cut off. Yeah, the index target. Next near resistance is 20,200. Next resistance 21,000, and key resistance is expected to be around 21,500. And just to repeat again, we will advise investors to be more cautious in the next 1-2 months. First of all, to await Donald Trump's new policies to take shape, and on the other hand, to wait for the March meeting, the meetings in March by China. In stock pick, our stock pick strategy, to shed some light on our stock pick strategy. Due to the expectation that policies introduced by, sorry, I moved this. Yeah, the policies introduced by Trump upon taking office will drive inflation, leading the Fed to slow down its interest rate cuts. Hong Kong defensive sectors such as utilities, real estate, banking, insurance, and telecommunications may become less attractive. These are Hong Kong companies. But for Chinese companies, we still favor China Mobile and China Telecom, which are paying good dividend yield and also very defensive. And China is expected to cut interest rate further this year. So Chinese telcos will do well compared to Hong Kong telcos. Okay, Chinese banks also did well late last year, and also entering 2025 because of attractive dividend yield. But whether their asset quality uh, see any deterioration remains to be seen. Okay, so far there's no obvious their NPL or their bad debt provision. We don't see sudden increase in bad debt provision and also a rise in the NPL. But whether this will change over time will remain. We'll have to watch out. Okay, this could result in capital flowing out to pursue more conservative investments that provide stable returns, such as bonds, negatively impacting these defensive sectors. Currently, the US economy remains very robust. Unless there is a significant contraction in the US economy that forces Trump to change his policy direction and leads the Fed to cut rates more aggressively. Otherwise, the upside potential for these sectors will be quite limited. Okay, so the rate sensitive interest rate plays, we're not so favor as we did in 2023 and early part of 2024 when the Fed starts cutting interest rate. Okay, we are more upbeat on sectors with strong competitive advantages, better business performance, and profitability, particularly those closely aligned with Chinese policy directions. Key Chinese policy directions include stimulating domestic demand, enhancing consumer spending expectations with home appliances, electric vehicles, and e-commerce platforms being primarily beneficiaries of subsidy policies, improving stock market performance to create wealth effect, benefiting brokerage firms and the domestic insurance sector. New quality productivity, 精知生产力, promoting high-tech development. China is focusing on advancing high-tech sectors, particularly in semiconductors, robotics, and AI. The National Integrated Circuit Industry Investment Fund Phase 3 has a registered capital of 344 billion RMB, with all 6 major domestic banks as shareholders. His fund is set up aiming at to support the development of more advanced chip techniques, such as the 7 nanometer, 5 nanometer, of being able to manufacture 7 nanometer down to 2 nanometer chips. Yet China is still restrained by the access to the equipment for such for manufacturing such products. Okay, China's current policy is to engineer a slow. It's worth to take note that China's current policy is to engineer a slow bull run rather than a crazy bull run, avoiding aggressive stimulus measures. So we do not expect the stock market to rally very quickly. We only expect the stock market to rise gradually rather than experiencing rapid increases. This gradual growth will be driven by the implementation of more policies aimed at improving the Chinese economy and corporate earnings. As such, the competitive advantages and operational capabilities of companies will be especially important. JD.com is our first stock pick. The ticker is 9618. Is a leading technology-driven e-commerce and retail infrastructure service provider in China. Its advanced retail infrastructure allows consumers to purchase any desired products anytime and anywhere. JD.com opens its technology and infrastructure to partners, brands, and various sectors, driving improvements in productivity and innovation across industries as a retail infrastructure service provider. It also has other business lines. Its main business segments include JD Retail, online marketplace, and marketing services. JD Health is an online and offline retail pharmaceutical platform, integrated online and offline healthcare services, catering to both retail and corporate clients. JD Logistics, primarily responsible for the logistic operations of internal e-commerce platforms and external logistic businesses. Okay, one distinctive difference between JD.com and Alibaba's Taobao and Tmall is JD.com now adopts a strategy of self-run, self-operate brands. So a lot of the merchandise offered on this e-commerce platform are sourced by JD.com itself. So which implies better, higher profitability, better profit margin, because these are sourced by the company itself instead of third-party merchandise, and they earn a thinner commission sharing from those from their clients. Okay. Third quarter results quite impressive. Revenue increased by 5.1% to 260 billion yuan in the third quarter last year, despite the economic downturn in China, insufficient consumer confidence, and a downgrade in consumption, requiring the company to provide greater consumer subsidies. The operating profit margin and net profit margin, you can see from this table that the operating profit margin improved by 0.8 percentage points to 4.6%, and net profit margin increased by 1.3 percentage points to 4.5%. This demonstrates the company's strong management and operational capabilities in face of headwinds. Looking ahead, as China implements more policies to stimulate consumption and improve the economy, the company is expected to benefit from various related policies. Importantly, its e-commerce platform excels in selling various electronic products and home appliances, which will continue to benefit from China's trade-in for new subsidy policy. Okay, entering 2025, there's another twist to this trade-in for new subsidy policy. Last year, this trade-in for new subsidy policy only applies to home appliances and EVs, electric vehicles. But lately, they announced that they will expand the scope for this trade-in for new subsidy policy to include other electronic products such as handphones, iPads, and uh, iWatch, intelligent watch, okay, smartwatch. Okay, over the last few days, you notice that some of the handphone uh, players in Hong Kong, listed in Hong Kong, such as uh, ACC Acoustics 2018, Sunny Optical, uh, they outperform the market because expectation of more demand for smartphones as it's subject to it's also entitled to subsidy under the trade-in for new subsidy policy. Okay, now the share price actually corrected from close to 200 Hong Kong dollars seen in early October last year. Now it's trading around 130. So if it drops towards the 250 250-day moving average, which is around slightly below 120 Hong Kong dollars. Recommend entry level would be around the 120 dollar 118 to 120 Hong Kong dollar level would be a good entry level. Okay. Another topic is Li Auto. The company is one of the leaders in China's new energy vehicle market with 5 models currently for sale. Li Auto has been the top-selling Chinese brand for new energy vehicles priced over 200,000 yuan for 7 consecutive months. In October last year, Li Auto surpassed the milestone of delivering over 1 million vehicles, becoming the first Chinese luxury car brand to achieve this milestone. A lot of the Chinese auto makers, their average selling price is around 100,000 or even below 100,000. So Li Auto is more on the high end. It's the price for its SUV, sport utility vehicles, L6, L7, L8, and L9 range from approximately 240,000 yuan to 460,000 yuan, and its most priciest model, Li Auto Mega, is selling around 560,000 yuan. And in 2024, it delivered a total of 500,508 vehicles, bringing its cumulative deliveries to approximately 1.1338 million vehicles since it's starting to, since the beginning of its vehicle deliveries. Third quarter results, except gross profit margin, slightly declined by 0.5 percentage points to 21.5%. Revenue, gross profit margin, and operating profit all saw double-digit growth in the third quarter last year compared to the corresponding period in 2023. Operating profit margin improved by 1.3 percentage points to 8%, and net profit remained stable at 2.8 billion. So despite the economic downturn in insufficient consumer confidence in China, Li Auto saw rapid growth in revenue and gross profit in the third quarter. The gross profit margin only slightly decreased by 0.5 percentage points, maintaining a GPM of 21.5%, which is comparable to industry leaders BYD and Tesla, and significantly higher than other new energy vehicle competitors. Liu has a gross profit margin of 10.7%, and Xiaopeng Xpeng has a gross profit margin of 15.3%. Both are much lower than that of Li Auto. Additionally, driven by China's trade-in for new policy for EVs, the company's monthly sales figure have recently exceeded 50,000 units a month, approaching historical highs. Looking ahead, Li Auto plans to develop AI integration with its EVs and is also working on humanoid robots. Okay, the share price corrected from close to 125 to currently is around 90 Hong Kong dollars. So we reckon that 85 would be a good entry level if one is upbeat on the outlook of this company, 85 Hong Kong dollars. Okay, so that ends my presentation today. Thank you very much for your time. Now we see what are the questions from the audience. I think I have covered some sectors already just now, so I won't repeat. With the recent addition of Tencent on the military company blacklist, what are your views on potentially more Chinese companies being targeted by US and Trump? Yes, that is the potential risk involved, okay? Especially some of the tech companies, okay? For SMIC Hong Kong stock, what is the near future moving direction? We are upbeat on SMIC, as I explained just now, is 12-inch chip production line. Now the utilization rate is reaching above 90%. So with higher utilization rate, we expect more growth in revenue, and also the penetration rate of 12-inch products now approaching 80%. So it also will raise the average selling price. More output of 12-inch, more utilization rate, and higher selling price will translate into bigger income, higher income, and better profit for the company. So let me show the price chart of SMIC. We need to open a new page for the price chart. Here, before we show the price chart, I also recommend to you, if you can understand Mandarin, 普通话, you may wish to view our daily video, our daily opening bell. In Chinese, it's called 开市起跑线, opening bell, 开市起跑线. Maybe you can show a bit the YouTube. No, you show the YouTube. Can you show the YouTube here? Open the 开市起跑线. So it will be uploaded to YouTube every morning around 9:30. So you can have a market sense, the pulse of the Hong Kong market. Okay, this is today's today's 开市起跑线. We talk about the wrap up of the market the previous day, and then the technical analysis of the market indexes, major indexes, and sometimes maybe individual stocks. And then what are the market moving news, economic data we'll also cover. Not only Hong Kong, China, we also cover the US as well. So it's about 10 minutes in total. So you can just spend 10 minutes watching this YouTube video produced by Phillip Securities Hong Kong. Then you will get a sense of the Hong Kong and China market every day. 开市起跑线. Okay, thanks. What is it? And then this we look at 981 SMIC 981. Okay. The share price recently outperformed. You can still see that today, despite the sell-off in the broad market, its share price still holds above the 10-day moving average. So we do expect its share price to be able to hold above 29 Hong Kong dollars, and then near-term target is 32, and above 32, the next target will be 35 Hong Kong dollars. So we are bullish on this company at the moment. Okay, is it good idea to buy S&P index? How can buying the index be a good investment? Based on the earnings growth, projected 20% earnings growth, projected by some of the iBanks for S&P 500 companies in the next 2 years. I think you wait for the correction. The highest was around 6,000, less than 6,100 S&P 500. So we expect from time to time there will be a 10% correction from the peak, the recent peak. So by 6,100, if 10% correction will be around 5,500, between 5,400 and 5,500. You may take some S&P ETFs when the index falls to that expected level. Okay, is Linkread a good buy at current level? No, because the rental first the rental is undergoing a downward pressure because of the weakening economy in Hong Kong, and as I mentioned just now, it's also rate sensitive, interest rate sensitive. If the Fed slows down its rate cut pace, then Linkread will also be slightly negative to Linkread. Can we show 823 the share price, the price chart? Okay, you can see that now it's trading below the four key moving averages: 10-day, 20-day, 100-day, and 250-day. Okay, so now it's around today is around 30. Now it's around 32.90. So we expect its share price to maybe to test again the $32 support in the near term, and if $32 does not hold, then another support level will be around $30. If you want to get in, maybe wait until the share price drop to 30, close to 30, maybe $30.50. Your thoughts on Hong Kong office and retail real estate and their impact on Hong Kong land? There's rally last year, even before it announced its plan to restructure business into fund management REITs. I just now share my thoughts on the real estate office and real estate sector. So we're still downbeat about because vacancy rate is still rising, partly because of the change in working mode to work from home or even work at home after the COVID pandemic. And now some foreign companies are downsizing in Hong Kong or moving their headquarters to probably Singapore or other countries. So the office sector and also retail on this a lot. If you come to Hong Kong, if you travel in Causeway Bay, Tsim Sha Tsui, or Mong Kok, you see a lot of empty, vacant street level shops because of weakening demand for shop space. So we are still downbeat about this sector. What's your views on Chinese bank? they are supported by their attractive dividend yield, and also they are more resilient because they are big. Among the four state-owned banks, our topic is not actually it's not ICBC or CCB. It's actually Agricultural Bank of China, ABC. It posted faster growth in earnings and interest income, and also less pressure on the net interest margin, better net interest margin compared to ICBC and CCP. Okay, insurance company, we are downbeat, as I mentioned just now, explained just now. They suffer because of lower bond yield, declining bond yield in China, and also the lackluster stock market. Okay, AIA also we expect slower growth in new enterprise value, new enterprise business because of slowing down Chinese economy, and they rely quite very much on Chinese citizens coming to Hong Kong to buy insurance policies. Okay. Hang Seng fell 2%, more than 2% today because PBOC reportedly plan to cut interest rates. Why so? No, actually the sell-off was driven more because of the negative news stemming from Tencent. Okay, Tencent being placed on the list, US the military company list. Okay, please comment on Hua Hong Semiconductor. Hua Hong, the gross profit margin pales compared to this SMIC. SMIC lately, the GPM, the gross profit margin, has improved back to above 20%, whereas Hua Hong is still expecting around 13%, 13% GPM. So that means doing two companies doing $100 business, SMIC is able to make a profit of $20 from $100 business, but Hua Hong is only able to make $13 profit from $100 sales. So we prefer SMIC to Hua Hong. Let's look at 1347, the share price. You can see it's the share price underperformed that of SMIC. I can see now it's still trading below the four major moving averages, the 10-day, 20, 100, 50-day moving average. Okay. I think time is running out. I'll answer two more questions. Okay. Then I'll see you next time in 3 months' time. Anyhow, do you factor in political risk that has nothing to do with fundamentals for China's stocks? Highly uncertain. And then with a even more uncertain president, Donald Trump, this policy risk, political risk, will be much greater, I think, in 2025 compared to 2023 and 2024. Okay, last question. Since the last Hong Kong stock rally last year, with perceived revival of the economy, Hong Kong stock has fallen further since then and looked flat recently with a slow and lackluster stimuli by the Hong Kong regulators, by the China regulators. Meanwhile, Hong Kong dollar has appreciated significantly against Sing dollar, hence making Hong Kong stocks even more expensive to buy. Is Hong Kong stock still a good buy with profit taken in near term? Well, we reckon that if the Hang Seng Index falls again to, let's look at Hang Seng Index. Now it's above 19,000, partly because of the combination punch, policy combination punch announced in September. Okay, but this, we are afraid that this may not be able to hold above 19,000 if we continue to see limited impact from policy support on the Chinese economy, and also the lackluster local economy in Hong Kong. So it requires the Hang Seng to falls back to, now let's look at longer daily, can you see longer? All in all, I would say when it falls back to between 17,000, 18,000. So yeah, uh, not long enough. Uh, okay, yeah, yeah, yeah. So now we are still enjoying the stimulus from the so-called combination punch policy announced in late September and October, but we expect this effect to wear out over time. And then if it drops to between 17,000 and 18,000, that's before the announcement of the combination punch policy, and with uh, average PE, price earning ratio of less than 8 times. So I think that would be an attractive entry level for the Hong Kong stock market using the Hang Seng Index as a benchmark. That would be between 17,000 and 18,000. Wait until it falls below 18,000. Then you can you can do bargain hunting, pick the stocks you think with good fundamentals and good prospects. So thank you for your time. I think I will end here.
Thanks again, Louis, for the presentation and the interactive Q&A. We have now come to the end of the webinar today, and we would like to thank all of you for joining. For the session just now, we will be uploading the recording on PhillipCapital's YouTube channel. You may view the recording of the webinar on your own time. Also, we have many other interesting webinars going on almost every other day. You may view our full list of free webinars on our website. Do take your time to fill in the survey so we can improve your experience with us in the future. You may scan the QR code on the screen. You may also join our investing communities to get free access to full research reports and discussion on technical analysis. Once again, thank you all for joining us, and we hope to see you tomorrow. For tomorrow, we would have speakers from the emerging markets, including Indonesian, Thailand, and Japan markets, moderated by our head of research, Paul Chiu, to discuss topics towards the respective markets in a fireside chat format. Stay tuned, take care, and have a nice day.